Let us today study about one of the very important topic, that is principles of management. Just like principles guide our actions in daily life, accounting principles guide how business record and report financial transactions. These are standard rules made to ensure that every company follows the same method while preparing financial statements. They are important because they bring clarity, fairness, and consistency to financial data. Without them, comparing two companies or making investment decisions would be confusing. These principles solve problems like misleading reports, errors, and miscommunication between business and stakeholders. The Institute of Chartered Accountants of India (ICI) sets accounting principles in India. These principles are based on legal guidelines, practical business needs, and regulatory requirements to ensure accuracy and trust in financial reporting. This blog will help you understand the core accounting principles in a simple and structured way. If you are looking to build a strong foundation or start a career in finance, we have also suggested online accounting courses to support your learning journey. What are the principles of accounting? Accounting principles refer to the rules and guidelines followed by companies while reporting their financial data. Through these rules, experts can examine the financial data by standardizing accounting methods. These principles ensure that the quality of the financial information reported by company is improved. Let us discuss the concepts and basic principles of accounting in the next section. Accounting principles. Materiality principle, full disclosure principle, accurate principle, consistency principles, cost principle, conservation principle, economic equity principles, matching principles, going concern principle. List of principles of accounting. Following are the 12 widely adopted principles in accounting. Accrual principle. It is one of the important accounting concepts and principles that mandate the recording of transactions in time period in which they occur. It is regardless of the time when actual cash flows for the transactions are received. Through accrual principle, one can gain an accurate insight into the financial status of the business. Most large-scale business adopt an accrual system to determine the cash flow of the business operations. Along with this, revenues and related expenses are recorded in the same time period of reporting. Both IFRS and GAAP support this concept. In case a business has more than $5 million in revenue, then such business must adopt this system for the purpose of taxation. Consistency principle. According to this basic principle of accounting, when an organization adopts a specific accounting method of reporting or documentation, then it should stay consistent with the method. The aim of this basic accounting principle is to make financial statements comparable across industries and companies. This principle has two issues associated with it. First, the principle is not properly followed when many people are recording data and compiling reports. To combat this issue, organizations need to have a set method internally. The second issue is related to switching between the financial reporting methods. Some organizations do this in order to manipulate the data to their advantage. Conservation principle. The conservatism principle gives you a realistic perspective of unexpected situations. According to this principle, one should recognize expenses and liabilities at the every stage, even if there is an assurance of its receival. This principle can be applied to recognizing the estimates. The conservation principle is the foundation of lower cost or market rule. As per this rule, one should record inventory at a lower end of its current market value or its acquisition cost. The historical cost principle. is another name for the cost principle. Whenever a business acquires an asset, its initial value is recorded in its financial reports and business. The value might not be improved in the market value of inflation. It is also not updated to reflect any depreciation or even appreciation. This value is known as the cost principle. As per the principle, companies keep a record of their tangible assets without reflecting the market value. Through this principle, companies can assess the actual cost of using financial services for calculating the historical cost principles of assets of the company. Economic entry principle. This principle is one of the basics of accounting that requires business to be treated as a separate financial and legal entity. This means that the recorded activities of the business entirely must be kept separate from the recorded activities of the owner and other entities. These may include either sole trader, limited liability partnership, or general partnership. Matching principle. The matching principle is concept in accounting that states that companies must report their expenses and revenues simultaneously. The revenues and expenses are matched on income statement for a specific time period. It is part of accrual accounting method of that provides an accurate representation of operations on the income statement. This principle is quite useful for investors as investors can match revenue and expenses to get a better sense of the finances of a business. Along with the income statement, there is need to assess the cash flow statement as well. Materiality principle. As per the materiality principle, any item that may impact the decision making process of an investor must be recorded. These details must be recorded in length in financial statements using generally accepted accounting principles. The material principles states that the accounting standard can be ignored if the end result is small. It is an important principle for deciding if a transaction should be recorded as a part of closing process. Full of disclosure principle. In the full disclosure principle, each piece of information should be included in the financial statement of an entity. This is necessary since it might affect the reader perspective of understanding the statement. It is important to only disclose information about events that have a material impact on the financial position of an entity. As per the full disclosure principle, it may also include those items that cannot be quantified. Businesses are also liable to report existing accounting policies and any change in them as well. Going concern principle. According to this accounting principle, a company will complete its recent plans, meet its financial obligation, and use its existing assets. The process of continuing operations indefinitely must go on until the company has any evidence on the contrary. Though this principle, the company continues to make money to avoid going bankrupt. In case the company is unable to adopt this principle properly, the chances of liquidation and bankruptcy increases. Going concern concept is also known as the continuing concern concept. A company continues to be a going concern till time the sale of assets does not hamper its operations. If a company is no longer is continuing concern, it needs to start reporting a specific information on financial statements. Through the principle, accountants can make decisions relating to which information should be reported on financial statements. Monetary unit principle. According to this principle, business transactions should be recorded only when they can be expressed as currency. Accountants should avoid recording non-quantifiable entities in the financial accounts. Whenever a transaction or an event occurs, it is first converted into money. After that, it is recorded in financial accounts of a business. It ensures that every accounting record is measurable in monetary terms by currency. Reliability principle. This principle ensures that every transaction, business activity, events, etc., is reliable when presented in financial statement. Information should be associated with objective evidence and it can be checked, reviewed, and verified. This makes the information more reliable. Along with this, the information should be accurate and have a transparent representation. This makes the information reliable for its users. This principle ensures every financial statement and business accounting records are accurate. Time period principle. There are two main regulatory bodies that develop the principles based on the accounting concepts. GAAP and IFRS develop these principles. US based companies follow GAAP principles, whereas outside the US, most countries follow IFRS guidelines. GAAP is static in comparison with the IFRS. IFRS builds principles to address the evolving financial condition in the world. Revenue recognition principle. Revenue recognition is a part of GAAP that identifies certain conditions in which the revenue is recognized. The revenue is recognized when the critical event has occurred. The principles uses the accrual method of accounting. According to this, revenues are recognized when realized and in earned. It is a straightforward principle where revenue is recognized when customers make payments. Whenever the production takes longer, the accounting for revenue becomes more complicated. This is one of the standard accounting principles in the industry. Get acquainted with objective principle. It refers to the concept of considering financial statements as solid evidence. These statements should not be biased or opinionated. While constructing financial statements, these statements should be helpful in evaluating the financial results, financial position, and cash flow of the entity. This principle of accounting must be from the viewpoint of an auditor as well. Regulatory bodies for setting principal accounting. According to this principle, all revenues and expenses can be assigned systematically to consecutive and distinctive accounting time period. Although the principle does not require every transaction to be assigned to a specific accounting period. How do accounting principles work under? Basic principles of accounting work on set standards due to which they minimize irregularities as well as data mismanagement. Since these accounting principles are in line with the international standards, they can help identify cross-border investment opportunities. These are the snapshots. Importance of principles of accounting. Accounting principles and concepts determine income, expenses, assets, and liabilities for financial reporting. Companies implement these principles while preparing financial statements. These properly formulated financial statements help investors in analyzing useful information. It becomes easier to compare financial information differently. Limitations. According to this principle, there are some limitations. These financial recordings are measured in monetary value, due to which the significance events that are not monetary in nature are not accounted for. Accounting principles are maintained as per historical cost and are treated as per time value of money. Only past records are accounted for, leaving no scope for recording of any future events. In the case of accounting principles, form is given importance over substance. Basic accounting principles relevant for principles. Accounting principles, accounting year, business entity concept, cost concept, dual aspect concept, realization concept, money measurement concept, going concept. Conclusion. I hope that this article has explained the principles of accounting in detail. These principles are necessary for enhancing the significance of financial statements. Implementing these principles uniform on inform the process of preparing the financial statement. These principles ensure that stakeholders or investors have a standardized accounting system to compare business performance globally. Thank you. I hope that you must have understood the principles of finance. Thank you.